The second quarter of 2026 started with a bang, quite literally. In the beginning of April, we were in the midst of chaos, a lot of uncertainty and fear in the markets. Oil prices were at their peak. Most of equity markets were at the bottom of their drawdowns. There was a lot of concern about inflation and interest rate hikes. And then going into the second week of April, it seemed like the market just moved on. Now, this is not something new, and it's not something that we haven't seen before. But in this specific circumstances, what happened was there was an initial ceasefire that was announced. Up until the ceasefire announcement, we saw a very strong reaction in the equity market to the changes in the oil price. And then from that point onwards, it seems as if the equity markets were just ignoring the movements in the oil price. This was not just because of the announcement of the ceasefire. At that same time, US earnings for quarter one came out, and a lot of renewed optimism was found in and around AI monetization. We saw explosive demand for memory coming through, and there was just more exciting things for the market to focus on. Like I said, this has happened before. There comes a point in every crisis where the market simply decides to move on. And it's not because the war is over or the crisis has solved itself. It is because the market has assessed the risk, processed it, and got to a point where it thinks, or with a relative certainty thinks, that the worst case scenario won't be the most likely outcome. The world isn't going to implode on us. Allow me to take you back to 2022 when Russia invaded Ukraine. It was a very similar narrative, just different characters. Oil prices were super high, equity markets dropped, inflation concerns, rate concerns. I'm just repeating myself at this point. But that war is still ongoing. That conflict hasn't resolved itself, yet markets have moved on a long time ago. The good news is that it seems as if the US-Iran conflict is de-escalating following the peace agreement that was signed in the middle of June, to the point that oil prices have calmed down quite significantly. At the end of June, oil prices were only 8% higher than a year ago, and it's come down more ever since. But we cannot think of this conflict and the impact thereof in isolation by just looking at oil and equities, as I've been going on about today. We have to think of the broader macro impact. I've already alluded to concerns around interest rate hikes and inflation. And that is because higher oil prices, or at least sustained higher oil prices, feeds into higher energy prices. And we've already seen the impact that that has on CPI prints across the board. That, of course, warrants concern for higher interest rates. But we actually saw that South Africa and the European Central Bank were one of the very few central banks to raise interest rates in their last meetings. In the United States, where there was a lot of concern of going into a hiking cycle, expectations for the rest of the year is now actually that interest rates will remain unchanged. Now, moving on to performance. Consistency is at the very heart of our investment philosophy and process, and that is why we will always choose to emphasize our longer term numbers first. You are very welcome to go to the actual quarterly commentary report to have a look for yourself, but it doesn't mean we can't get excited when we have a quarter of stellar performance. That is exactly what happened in quarter two of 2026. All 6 of the funds that we offer outperformed their respective ASISA categories over that period, with the exceptional performance coming from enhanced opportunities as well as the global flexible fund of funds. What is important is that we didn't do this because of any dramatic shifts. We didn't change our process or our views too much. It was really just sticking with our knitting, sticking to the process, and not reacting in panic to the market volatility. If we look at the drivers of outperformance on a more granular level, a lot came from our exposures to NASDAQ and semiconductors. These form part of our thematic growth drivers. That's something that we are very excited about. But it is also important to note that that wasn't the only thing that went well for us. A lot of alpha was generated simply because of our asset allocation decisions, and that's where we manage very actively. So on the offshore side, we added a lot of alpha in our property strategy as well as our offshore bond strategy. And on the local side, our active Govie bond strategy performed really, really well. We saw a little bit of underperformance on the local property and equity strategies, but that was just for this quarter. And in the longer term, they actually still contribute positively to performance. So last quarter, I ended the quarterly commentary with an analogy that spoke to proactive risk management. What I said was, when there's a storm, You cannot control the winds and the waves, but you can adjust your sails to navigate safely through them. And I truly believe that this quarter we proved that we can do exactly that.